This past fall, Horwath partnered with Bank Director to conduct our third annual Bank M&A survey to find out what bank executives and directors think about the state of the M&A market. I'd like to take a few minutes to share my insights on some of the key findings. Although 76% of the respondents to our survey are expecting deal activity to increase in 2014, it seems unlikely that the wave of acquisitions oft predicted in the past will be realized. Based on a review of historical activity, when there were higher levels of deal activity, the industry also had a larger number of bank charters. In general, about 3.5% of the banks are acquired on average in a given year. Looking over the last 10 years, one might predict that somewhere between 200 and 250 open bank acquisitions will occur each year. 2013 was a year that was modest compared to 2012, but consistent with 2011. My expectations for 2014 are for a slight increase in deal activity. One group to watch is buyers in the $5 billion to $10 billion category. These institutions have been active acquirers, and many are approaching the Dodd-Frank $10 billion threshold. Many of these acquirers are planning on sitting on the sidelines in the coming months to integrate prior acquisitions, strengthen internal processes, and plan for compliance with the aspects of Dodd-Frank, which will be applicable to those institutions reaching $10 billion. If this occurs, then it will likely temper improvements in deal volume. While more than half the respondents of our survey reveal plans to purchase a healthy bank, almost 70% of banks with between $1 to $5 billion in assets reveal plans to buy as well. 54% from banks of this size say their bank purchased a healthy bank in 2013, well above the average of 24% for the rest of the respondents. If you look at the last 2 years of acquisitions, the average size of the seller has been approximately $200 million, while the average buyer has been around $1.6 billion. I think this indicates that the size of the available seller has been in the sweet spot for the acquirers, who are in the $1 to $5 billion asset size. Almost 90% of the sellers in the last 2 years had assets below $1 billion, with almost 40% of the deals involving sellers below $100 million in assets. Large banks are interested in acquisitions, but many of them are on the sidelines due to the lack of attractive sellers and regulatory pressures on the largest of the banking companies. Based on our survey, buyers and sellers still can't seem to come to terms on deal pricing. However, pricing has improved as the industry has continued to see improvements in the levels of non-performing assets. However, the level of non-performing assets is still higher than the historic norms, and getting to the right price is still a challenge for buyers and sellers. The improvements in deal pricing can best be described as incremental as opposed to material. The survey clearly continues to indicate that a chasm still exists between buyers and sellers' views on pricing. At the core of this difference are credit concerns. Buyers are still skeptical of credit assessments at sellers, and at the same time, sellers don't believe buyers are giving enough credit to the work that has been done to manage problem credits. Additionally, capital concerns for buyers can make it difficult to get to the right price as they begin to plan and implement Basel III. On the other hand, some buyers have experienced significant improvements in the trading price for their common stock. As their currency value has increased, so it increases buyers' ability to manage capital, tangible book value dilution, and ultimately get to the right price to get the deals done. Respondents of our survey were evenly split when it comes to considering a merger of equals. For most merger of equals to be considered successful and truly a merger of equals, then as the name suggests, it would be helpful if both institutions were reasonably close in size. When one institution is considerably larger in size than the other, it really is an acquisition that someone is trying to pass off for social or other reasons as a merger of equals. When both parties to the transaction bring strong qualities to the merger, then the ability to create synergies of scale and combined operational improvements can make a merger of equals viable. Many successful mergers of equals will result in transformation of both organizations into a stronger and new organization, and not merely a carryover of old ways and methods. Unfortunately, many institutions with weak performance and poorly defined business models think that a merger of equals is the answer to what ails them. These types of transactions often don't lead to a transformed organization, and as a result, the merger proves to be less successful. 58% of respondents think that it's harder to get regulatory approval for a deal, And it is true that regulatory approval is more complicated and time-consuming than before the credit crisis. However, our recent experiences with clients and anecdotal accounts indicate that the process is not overly lengthy, unless the deal is very large or other non-deal issues exist at the buyer or the seller. For example, if a BSA AML issue exists, then the regulators may require some additional information on how the issue will be addressed and plans to manage the issue post-acquisition. But if there are not significant issues, then we have noticed reasonable timeframes for approval, and in some cases, almost surprisingly speedy approvals. At a recent M&A conference, a representative from the Federal Reserve provided statistics on the average length of time to achieve regulatory approval, and it did not indicate an overly lengthy period of time for most transactions. In looking at data from S&L Financial, the number of months between agreement and deal completion for the last 2 years have averaged 4 months, with the shortest being 1.5 months and the longest 14 months. For additional results from our survey, please visit bankdirector.com or review the first quarter 2014 issue of Bank Director magazine. And please join us next fall as Bank Director and Crowe Horwath again conduct a survey of bank directors and executives on their expectations for bank M&A.